Hi everyone, and welcome back to Investment Research. I'm Simo, your equity research analyst. Today we're going to dive into two dividend ETFs that have been gaining serious attention from income investors looking for higher monthly payouts, JEPI and SDIV. Now, if you're holding SCHD or thinking about it, you already know it's one of the best dividend growth ETFs out there. It's stable, efficient, and focuses on quality US companies with consistent dividend histories. But there's one catch. SCHD pays quarterly and its yield sits around 3.5% right now. So the question is, what if you want a stronger income stream that pays you every single month? That's where JEPI and SDIV come in. Let's begin with JEPI, the JP Morgan Equity Premium Income ETF, which has quickly become one of the most popular high-income ETFs in the US. And for very good reason, as it skillfully combines blue-chip stability with premium income through a clever covered call strategy. Specifically, JEPI primarily invests in large-cap US stocks, holding names many of us recognize like Microsoft, Amazon, and Coca-Cola. But crucially, on top of those holdings, it actively writes covered call options on the S&P 500. This generates significant extra cash flow, resulting in a yield that typically hovers around a very attractive 7 to 8%, and importantly, that payout is distributed monthly. To put that in perspective, if you had $100,000 invested in JEPI, you could realistically expect to receive somewhere in the range of $7,000 to $8,000 per year in dividends, and that's even before factoring in the power of compounding. From a valuation perspective, JEPI's underlying holdings boast a forward PE ratio around 17x, which is quite reasonable for a portfolio concentrated in high-quality large-cap US equities. However, what truly draws many investors to JEPI is its inherent volatility management. Due to that intelligent option overlay, this fund tends to exhibit less price movement than the broader S&P 500, which is precisely why JEPI is often affectionately described as a sleep well at night ETF. Moreover, institutional investors appreciate JEPI because JP Morgan employs a very rules-based and disciplined structure, meaning it's not speculative but rather intently focused on income, utilizing a core writing strategy that has demonstrated its robustness and effectiveness across multiple market cycles. The primary trade-off, of course, is that by selling calls, JEPI does cap some of its upside potential. You won't capture the explosive growth seen in funds like QQQ or even SCHD during strong bull runs. But what you gain in return is far more consistent and predictable cash flow, which is precisely the priority for many retirees and conservative income-focused investors. Now, let's shift our focus to SDIV, the Global X Super Dividend ETF, which operates with a distinctly different strategy. This ETF takes an unapologetically global approach, aiming purely for the absolute maximum yield available by holding 100 of the highest dividend-paying companies across the world, with its holdings rebalanced on a quarterly basis. The current yield, astonishingly, sits close to 9.7%, also paid monthly, making it one of the highest among all major dividend ETFs. With SDIV, you're gaining truly diversified exposure to income sources from virtually every corner of the globe, the US, Europe, Asia, and even emerging markets, encompassing a wide array of sectors from real estate trusts and utilities to financials and energy companies. However, it's crucial to understand that with this significantly higher yield comes a corresponding increase in risk. SDIV has, in fact, underperformed SCHD in total return over the past few years, largely because many of its holdings reside in slower growth or more cyclical industries. Nevertheless, the ETF unequivocally serves a very specific and important purpose: pure income generation. If you are the type of investor who places paramount value on consistent monthly cash flow, perhaps for reinvestment, generating passive income to supplement your lifestyle, or for direct retirement living expenses, then SDIV delivers an incredible payout level that very few other ETFs can genuinely match. The price currently trades near $21 with an annual income potential of close to $2 per share, depending on the monthly distribution. This is a truly significant figure if your strategy involves building a robust dividend ladder or striving to achieve financial independence through high passive yield. So, how do these contenders truly compare to SCHD? Let's be entirely realistic. SCHD remains the undisputed gold standard for dividend growth and long-term stability. Its stellar 10-year performance consistently outperforms the vast majority of dividend ETFs precisely because it rigorously focuses on fundamental strength, identifying companies with robust free cash flow, a consistent history of increasing dividends, and overall exceptional quality. However, for those investors whose primary objective is more frequent payouts and higher current income, JEPI and SDIV are not replacements for SCHD, but rather can play a powerfully complementary role within an intelligently constructed portfolio. To summarize, SCHD offers about a 3.5% yield paid quarterly and is built for strong, sustainable growth. JEPI, on the other hand, provides a compelling 7 to 8% yield paid monthly, with moderate growth potential and lower volatility. And finally, SDIV stands out with an approximate 9.7% yield, also paid monthly, offering broad global exposure, but with an inherently higher risk profile. Imagine the strategic possibilities. If you were to blend SCHD and JEPI together, you would create a beautifully balanced portfolio that optimizes both long-term growth and immediate income needs. And by adding a smaller, carefully weighted allocation to SDIV, you could effectively boost your overall portfolio yield while still maintaining crucial diversification. In my view, JEPI emerges as the most balanced choice among the current crop of high-yield ETFs. It consistently delivers reliable monthly cash flow, incorporates intelligent managed volatility, and benefits from the solid institutional backing of JP Morgan's rigorous structure. SDIV, conversely, is tailored for investors who possess a clear understanding and acceptance of its higher risk profile. Think of it as your dedicated income booster. Its purpose is not centered on price appreciation, but singularly focused on getting you paid every month. And SCHD, it undeniably remains the cornerstone of any serious dividend growth strategy. My recommendation is to strategically employ SCHD for its unparalleled long-term compounding potential, integrate JEPI for its stability and substantial monthly income, and selectively utilize SDIV for targeted yield enhancement where appropriate. If your ambition is to construct a resilient dividend portfolio that can genuinely provide income for life, then leveraging these three ETFs in a thoughtfully weighted combination can accelerate your journey toward that financial goal far more effectively than merely chasing short-term trades. That's my analysis for today. I'm Simo from Investment Research. If you found this useful, please hit like, subscribe, and tell me in the comments which of these ETFs best aligns with your personal portfolio strategy: SCHD for growth, JEPI for stability, or SDIV for maximum yield. I'll see you in the next analysis.